Okay, welcome back students who are taking financial accounting, and in this series of videos we are working on the Appendix B time value of money exercises. Um, the Appendix B was associated with Chapter 7. We decided to include it here because to calculate the interest on notes receivable, it does help to know the time value of money concepts. Go back to the previous exercise video and the theory videos. On the time value of money. I didn't spend much time on the time value of money theory video, but if you watch that, it refers you back to the math for business / application section and the videos that in there that cover the time value of money more in depth. So if you had watched the theory video for the time value of money and did not go back, and now all of a sudden you're trying to do the time value of money problems here that are assigned, and you don't understand those concepts, go back and watch that the theory video for Chapter 7 here, which gives you the link, direct link, or you can find it by going to the business group and then math for business and / application section to see the detailed theory videos on the time value of money. Right, so with that said, note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Now, I reproduced the time value of money tables, okay, for the future value here, and on this next slide for the present value. Okay, so they're part of the appendix, and these are the tables that you're using for this work. Right, so in the last video we had done EB-1A, so now we're going to be doing EB-2A. All right, it says here, John Resch is considering two plans for building an education fund for his children. Plan A invests $3,000 at the end of each year for 10 years. This investment will earn 8% annual interest. Plan B, you invest $25,000 now, earning 6% annual interest for 10 years. Now, he's considering two plans, and most likely the question is going to ask which one is better, all right? But before making any calculations, which plan would you expect to provide the larger future amount? Right? Okay, take a moment to think about it. Pause the video, think about it, and then come back. Okay, now if you're back, you've kind of just thought about it quickly, and you have your choice between plan A or plan B without doing any of the math, right? If you think about it, in plan A, what will happen is a majority of the students will say, okay, I'm going to invest $3,000, but I'm going to invest it for 10 years. So 3 times 10,000, all right, it gives me 30,000, right? And I'll earn it at 8% interest. So most likely that's going to yield me a greater amount than if I invest $25,000 now as a lump sum, okay, for the 10 years at a lower interest rate. Okay, so on the surface, if you look at it, without really doing the math, just it looks like that this is going to be the better choice, because why? I'm going to end up investing $30,000, yeah, and I'm investing at 8%, right? But the catch here is that you're not investing the full $30,000 at 8%. You're investing at $3,000 at 8%. All right, each and every year. All right, only the last year do you have $30,000 invested at 8%. All the previous years you have less, right? First year you only have 3,000. Second year you have 6,000. Third year you have 9. Fourth year you have 12 at 8%, which is a greater percentage rate. But let's face it, the interest on 3,000 at 8% is a hell of a lot less than 25,000 invested at 6%, each and every year. So on the surface, it looks like this, investing $3,000 a year seems like it would yield a greater amount. But, bottom line here is if you're ever in this situation, you don't just jump at it and say, okay, this one looks better. You actually have to do the math. So with plan A, right, what do we have? We're going to start here, and over the course, and we're going to invest $3,000 at 8% each year. I don't know how many this is, but this is 10 years, right? I don't, 1, 2, 3, 4, 5, 6, 7, 8, 9. Oh, perfect, 10. All right. So I'm going to invest $3,000 a year at 8% for 10 years. Well, investing $3,000 each year is an annuity. Okay. And if we're starting today and we want to know how much it is 10 years from now, that's a future value, right? So we're going to look up on the future value of an annuity table, and we're going to see 8% for 10 years, and we cross-reference, oops, sorry, I'm on the future value of a dollar table, sorry. On the annuity table, 8% for 10 years, right, I have a factor of 14.487. So I take the 3,000 times the 14.487, come on, pen, 487, and when I multiply that together, I end up with $43,461 at the end of 10 years. So plan A, I'm going to have $43,461. Okay, pause the video and copy that all down if you have to, because now I'm going to work plan B. Okay, so with plan B, we're investing $25,000 today, okay, and we're earning 6%, and we want to know how much it is at the end of 10 years. So investing $25,000 today as a lump sum, right, and we want to know the future value. So we're going to go up and look at the future value. My pen. We're going to look at the future value here at 8%. I'm sorry, not 8%, 6%. 6% for 10 years, and that gives me a factor of 1.791. So now when I take the 25,000 times 1.791, that will yield me 44,775. So plan B is equal to 44,775. And of course, now which choice am I going to make? Well, obviously, I'm going to choose plan B because 44,000 is greater than 43,000. All right. So, the point for this particular exercise is that, when you're making comparisons, you don't just jump at a conclusion based upon the data and what you intuitively think is the better plan. You actually have to work through the numbers in order to decide which one yields the greatest return for you. Okay? And so with that said, I'm going to stop the video here and then pick up with problem 3A in the next one.